All right. Today is Thursday, October 21st. This is a recap for the stock market activities today. What's going on over here? Snapchat is down. It is crashing after hours, down over 20% last time I checked. And guess what? Facebook is down, Twitter is down, Google is down, Apple is down, everything is down. But you know what's not down? It's this new new SPAC from Trump. It is surging higher. The new Truth Social Media, which I always thought it's going to be Liberty Media, but it happens to be Truth Media. I got it wrong. Anyhow, the stock is surging higher, the SPAC that is, but social media stocks are crashing, and this is due to the earnings report from Snapchat. We will go over all of these earnings in a second, but I know you guys want me to cover the Trump social media app and a lot of other news. I'm watching CNN right now, and they're having a town hall with Biden. So we're going to have more news as we're speaking right now, because the budget deal is stuck. We have two senators, Manchin and Sinema. They don't want to raise taxes for the rich and corporations, yet they're okay with the reckless spending, trillions and trillions and trillions of dollars. So who's going to end up paying for all of this garbage? The answer is you and I, regular folks. Your taxes are going to go higher on top of inflation, which is already a tax on the poor and the middle class. This is getting horrendous. They know from the stock portfolios, these politicians, your beloved politicians, they know that if they jack up taxes on corporations, the stock market will crash right away. Because as you will see in earnings reports, corporate margins are shrinking and shrinking and shrinking as inflation continues to eat up their margins. You add on top of that extra taxations and the stock market blows up. All of these corporations go down, and all of a sudden the economy reverts from expansion to retraction, and we start losing jobs. So at the end of the day, somebody's going to pay for this crap, and it's going to be average people. We're going to cover all of this news and a lot more. We got more data from the housing market, etc., etc., etc. We're going to cover it in the headlines of the day segment. It's not going to happen today because we're recording this video already too late, but most likely the headlines of the day video will come out tomorrow. But for now, I want to concentrate on earnings, because earnings will dictate where the stock market is going to go in the next few weeks. Hint, it is going down to the dumpster anyways, because these earnings, inflation is eating those earnings little by little by little. These earnings are not going to support the cartoonish out-of-whack valuations in the market right now. So here it is. Let's start by reviewing some earnings that we talked about in last night's video. Today, we got earnings from American Airlines, Southwest, AT&T, Union Pacific, Intel, Chipotle, and Snapchat. We covered some of those yesterday, and let's get the updates, starting with American Airlines. This is what I was looking at yesterday, the earnings report for the quarter ended in June. And I was looking at the revenue growth year over year, quarter over quarter, versus the growth in expenses, specifically for aircraft fuel and salaries. Last quarter, the growth in revenues was about 590% year over year. Meanwhile, the fuel expenses were up 521% year over year. And I told you, so long as the growth in revenues is surpassing the growth in expenses, they're fine. But the growth in expenses are surging at a rapid rate, and soon enough, the surge in revenue will not keep up with the surge in expenses, because travelers will book flights for the holiday season ahead of time. But what will happen after that if fuel costs continue to rise higher and higher and higher? And this is the new report that we got. When it comes to passenger revenue, the growth year over year was 313%. On the other hand, the growth in aircraft fuel and related taxes was up 319% year over year. So now you're seeing the growth in expenses surpassing the growth of revenues. This is a bad sign for the airline sector of the market. They're not going to keep up if fuel costs continue to rise higher and higher and higher. On top of that, American Airlines expects Q4, the system capacity for Q4, to fall 11% to 13% from 2019 levels. Again, this is a zombified sector of the market, airlines. And soon enough, if this continues, we're going to have to bail them out again. And of course, your beloved media says American Airlines and Southwest Airlines reported profits for the 3 months ending in September, reflecting the industry's recovery despite the spread of the Delta variant of the coronavirus. This is garbage, of course, because when you dig in, Southwest Airlines reported a profit of $446 million, boosted by federal aid. Ta-da! We have a so-called thriving economy and the economic recovery, and airlines are recovering again. If they are recovering, then how come we need continuous life support for this market, for this economy, and for all of these airline companies? Next, we got the report from Union Pacific, and I told you this will be the most important earnings report to look at. And the reason is it is a leading indicator for inflation expectations, but most importantly, a leading indicator to how these so-called inflationary stocks will hold up to the increase in costs and the supply chain disruption. If these companies fail to keep up with the pace of inflation, then good night, Irene. If the inflationary stocks are struggling to keep up with the pace of inflation, then what would other companies who don't have the pricing power hold up in this massive inflation storm? And this is the report we were looking at last night. It is the report for the quarter, the second quarter. This is not the most recent report. This is the report that was before that. And we were looking at the freight revenues, the rate of growth in revenues versus the rate of growth in expenses, specifically compensation and benefits and fuel costs. And how would that impact the bottom line, the net income? Last quarter, revenues were up 29%, compensation and benefits were up 13% year over year. Fuel costs were up 200% year over year. All in all, the net income was fine, up 59% year over year. The company is still growing. Here's the problem. In the report we got today, the most recent report, revenues were only up 12% year over year. Compensation and benefits were up 3% year over year. The fuel costs were up 81% year over year, and all in all, the net income growth went down to 23% year over year. Here's the problem though. You have to put it in perspective via the quarter over quarter rate. And when we do that for the revenues, quarter over quarter, the growth was less than 1%. Meanwhile, for compensation and benefits, the growth quarter over quarter is 1.76%, and the growth rate for fuel expenses quarter over quarter is 13.8%. All in all, the growth rate for expenses is surpassing the growth rate in revenues, and therefore quarter over quarter the net income went down by 7%. This is not a good sign, folks. If this stock cannot hold with inflation, then who will? And here's the problem with Union Pacific and other railroad operators. The chief executives at CSX and Union Pacific said a lack of truck drivers, equipment, and warehouse workers is causing congestion in their yards, forcing the railroad operators to turn down some business during time of high demand. There we go. Inflation is surging out of whack. Even these companies, classic inflationary companies, are struggling to keep up with this inflation. Oh, and by the way, Union Pacific, they're having a jab mandate and they're suing their employees and the employees are suing them, and it is a massive mess here. They cannot afford to lose workers right now. There is a massive shortage of workers. Every single worker counts, and they cannot afford to lose anyone. Yet these jab mandates are going to hurt the economy in a massive way. Some of these workers are going to quit. Sorry, we're not going to do it. What happens then? Expenses are going to continue to rise higher and higher and higher, and Union Pacific will have to jack up their prices higher and higher and higher. All of this will be passed down to us consumers. Next, we have Intel. Do we even have to talk about Intel? It's a garbage company. It's a dinosaur. It's a dying dinosaur. And if they don't get their act together soon enough, the company will disappear. They're getting their asses kicked by AMD, Nvidia. And oh, by the way, all of these chip manufacturers, the likes of Intel and Qualcomm, they are a dying breed because you have other companies like Apple, for example, manufacturing chips in-house. We also have auto manufacturers, Hyundai and now Ford, thinking about manufacturing chips in-house. So say goodbye to these companies. They need a better plan. When it comes to Intel, they're blaming shrinking PC chip business on component shortages. So again, inflation and the shortages are wreaking havoc on this company. On top of that, their margins are also shrinking and shrinking and shrinking. This is a dying business. You want to avoid it like the plague. Next, we have Snapchat, the big one. Everybody's waiting for it. Here it is. This is the slide we were looking at last night. This is the earnings from the quarter before. And we were looking at the daily active users growth. In North America, it was 6% year over year. In Europe, it was 10% year over year. In the rest of the world segment, it was 55% year over year. This was the impressive segment. You also have to pay attention to the quarter over quarter growth, and the rate of growth was positive quarter over quarter in every single segment: North America, Europe, and the rest of the world. Here's the problem. In the earnings report that they released after the bell today, the daily active users growth is also positive. Year over year, 7% in North America, 11% in Europe, and then 49% in the rest of the world segment. It is down from last time around. It was 55% year over year last quarter. Now it is 49% year over year for this quarter. Not a big deal at all. They're increasing their active daily users across the board. We're not going to be mad at them based on this number. But it is evident that the rate of growth is slowing down. Here's the problem. Last night, we looked at the average revenue per user. And while the majority of growth in daily active users came from the rest of the world segment, the majority of the revenue growth came from North America. It was up 116% year over year, and it was also up quarter over quarter. Likewise, in Europe, the revenue per user was up 76% year over year, and it was also up quarter over quarter. In the rest of the world segment, it was up 20% year over year, but it also was up quarter over quarter. Here's the problem. The average revenue per user is still growing in North America, be it at a slower pace. It is now 49% year over year versus 116% last quarter. When it comes to the Europe segment, they are growing year over year 34% versus the 76% year over year last quarter. So the rate of growth in revenues is sliding down. On top of that, the rate of growth in revenue from the European user is also down quarter over quarter. When we talk about the rest of the world segment, the revenue growth year over year is about 3%. This is down from 20% last quarter. When we look at the quarter over quarter number, it is actually down. So this is the core of the problem with Snapchat. The rate of growth is slowing down. On the other hand, the stock price is trading at the stratosphere, meaning that the expectations were high. On the other hand, what Snapchat delivered was actually a slowing down in the rate of growth. What does that mean? It means that the forces of gravity will pull the chart down aggressively, and therefore the stock is trading down by more than 20% after hours. Here is yet another illustration with the problem for Snapchat. Last night, we looked at this chart right here, this table, the income sheet for Snapchat in the quarter ended in June. The revenue growth was 116%. Pay attention to this number, 116%. And the net loss was cut by half. This is good. Here's the problem. In the latest report that was released after the bill today, the revenue growth slowed down to 57% year over year. This is down from 116% last quarter. So this is not good, even though they're cutting their net loss by more than half this time around. So it is just a matter of time before this company becomes profitable. The problem is, if the rate of growth is slowing down, it will take longer for this company to become profitable, if it ever does, because we have another problem here. Snapchat is blaming these miserable results, the slowing down in the rate of growth in revenues, to Apple's policy. The iMob over at Apple, they have the racketeering operation they call the App Store, and they shake down businesses and apps for 30% of the revenue. And therefore, Snapchat have to share their revenue with Apple, the iMob, the racketeering operation. And if Snapchat is getting hurt by the racketeering operation of the iMob, then Facebook will get hurt, Twitter will get hurt, everything will get hurt. And every single business at the App Store, any company with an application on the App Store will also suffer the same problem. You add inflation, shrinking margins. Perhaps taxation will come, shrinking margins. And now they have to share the revenue with the iMob, shrinking the margins even more. This is a big problem. It has to be addressed. The problem is your beloved politicians are not going to do anything about it because they're all invested in Apple. They all have retirement accounts in ETFs. All of these ETFs are heavily weighted with Apple. They cannot pull this one down, cutting the racketeering operation, because Apple ceased to innovate. They don't innovate anymore. They don't have any new products that are exciting anymore. They don't have any of that. Their latest innovation is new colors. and a polishing cloth that cost you $19. So they have to resort to these mafia-like practices of shaking down other apps for money. Again, this is a major problem, not just for Snapchat, by the way, but for many other businesses. Next, we have Chipotle, and this is the earnings report that we were looking at last night from the quarter ended in June. The revenue growth was up 38% year over year. On the other hand, the growth rate in expenses was about 20.5% year over year. And specifically, we're looking at the labor costs since Chipotle is jacking up wages higher. The labor cost was up 17.40% year over year. This is, of course, for the last report. And I told you, so long as the growth rate in revenues surpasses the growth rate in expenses, the company is still fine. Here's the problem. In the latest report that they released after the bell, the revenue growth year over year was about 22%. Quarter over quarter, it was 33%. Impressive. The problem is the labor cost. Year over year, it is up 24%. Quarter over quarter is up 8.23%. The growth rate in labor costs is surpassing the growth rate in revenues year over year. Even this company will get hit with the rise of inflation. They're going to have to pay more and more and more for labor, for supplies, for rent, and they have to continue to jack up prices higher and higher and higher for you and I, the consumer. And this is exactly what they're doing right now. They're jacking up prices. The question is, how much longer and how much more can they continue to jack up prices higher and higher and higher before deterring customers from dining at Chipotle? On the other hand, their expenses will continue to rise higher and higher and higher. At some point, the balance between the rate of growth of expenses versus revenues will be tilted in favor of expenses, and therefore you're seeing the stock reacting negatively after hours. What do we have on the earnings calendar tomorrow? We have Honeywell and American Express. Let's start with American Express. This is an important name. I used to own the stock in my portfolio last year, but I got rid of it this year. And the problem is the stock is trading out of whack. Meanwhile, the actual fundamentals of the business are not recovering. This is the report from the second quarter. And as you can see, the growth rate by customer type. U.S. consumers, they've already recovered the pre-pandemic highs, or the pre-pandemic levels, I should say, but they're still lagging when it comes to small and medium enterprises in the US and the small and medium enterprises overseas, along with international customers, but specifically for large and global corporations. They have yet to recover the pre-pandemic levels. On the other hand, the stock is trading out of whack at all-time highs, surpassing the pre-pandemic highs. This is insanity. If the report doesn't come out impressive, way more than impressive, this will be the next shoe to drop. Just take a look at their expenses year over year. Of course, this is understandable. The numbers are inflated because last year, everything was shut down and they did not have a lot of expenses. But these are stunning numbers year over year. Certain expenses are doubling and more than doubling. I cannot be bullish on this stock given the valuations, but there's something important to look at in American Express earnings. It is also a leading indicator to consumer sentiment. You're going to hear numbers about the bookings for cruises and traveling, airlines, hotels. If these numbers come out impressive, then we know that the consumer is still strong and they're still spending. If these numbers are shrinking and stagnating, this will be a massive red flag. Next, we have Honeywell. This is Q2 earnings, the sales growth for the different segments of this company. The organic growth for the aerospace business was about 7%. The growth rate for the building technologies segment was about 13%. On the other hand, for performance materials and technologies, it was up 10% year over year. Lastly, for the safety and productivity solutions, the highest growth segment of the company, it was 35% year over year. The challenge is, can they continue to keep up this rate of growth year over year when expenses are rising higher and higher and higher due to inflation? Another thing to think about is the segment margin. All in all, it was 20%, 20.4% in the second quarter of 2021 versus 18.5% in the second quarter of 2020. Can they continue to keep these margins? I doubt it, because expenses are rising higher and higher and higher, and the economy all in all is stagnating. So even if business is hot and the demand remains hot, the materials and labor shortages will impact margins negatively. Anyhow, let's move on with the markets coverage today because we have a lot to cover. And here we go. The Dow Industrial Average closed in the red, down by 6.26 points, or a decline of 0.02%. The Nasdaq leading the gains today by about 94.02 points, or a gain of 0.62%. The S&P 500 also closing in the green by 13.59 points, or a gain of 0.30%. The likelihood is the Nasdaq will lose some of these gains, or already reversed the gains for the day after hours, and the reason is we have big cap technology names, specifically in social media, trading down after hours in reaction of Snapchat's earnings. What about the sector's performance? Leading the pack at number 1 and capturing the gold medal, consumer cyclicals, aka the Chinese names. At number 2 for the silver, technology, and at number 3 for the bronze, healthcare. The laggards of the day led by energy, materials, and financials. So the inflationary trade not doing so hot so today. The deflation trade is doing a little better. We're talking about REITs, we're talking about technology, but how long will this last? The market is yo-yoing back and forth between inflationary and deflationary. Meanwhile, watch out for the healthcare sector of the market. It remains for now the safest place to be. Now, what about the advance to decline ratios? The NYSE 47% advancing versus 52% declining. The Nasdaq 50% advancing versus 47% declining. Moving on to futures, we have losses across the board here with very few exceptions. The dollar traded higher, slightly higher, and this added some negative activities in the commodities market. We're seeing some profit taking here. The inflationary trade all in all did not do so good today. Perhaps impacting energy prices down for crude oil prices and heating oil specifically is the forecast that we got from the government today. The dear government says, the government scientists of course, expect a drier, warmer winter down south and a wetter winter up north. Okay, we already discussed that. This is not new. We talked about El Nino, but here's the problem. The government says we're going to have warmer than average weather in the south and most of the east coast this winter. The Climate Prediction Center said in its annual winter outlook. You see, when they fail to control inflation, it is surging out of whack, energy prices are surging out of whack, they have to resort to propaganda and the management of expectations. We are already living in this Orwellian future. It's not really future, it's present. 1984 is happening right before our eyes. It's all propaganda, it's all brainwashing, it's all the engineering of the public perspective. So you always have to play the devil's advocate and say, you know what if this is propaganda and this is not real? Let me do my own homework and see what's going on. Because even the CIA is becoming a weather service. They're issuing a weather forecast and warning that rising global temperatures pose a growing risk to U.S. national security. And I say the CIA has bigger fish to fry because this is what happened a few days ago. China tested a nuclear-capable hypersonic missile in August that circled the globe before speeding toward its target, demonstrating an advanced space capacity or capability, that caught U.S. intelligence by surprise. Wow. We didn't know that China could nuke New York or LA, and there's nothing we can do about it. I say the CIA should stick to this and leave climate change to the scientists. Because we have also the Federal Reserve, calling climate change one of their most top priorities. What are they going to do about climate change? How about stop printing? Because rumor has it the heat from the printer machine is adding to global warming. I believe that the dip in energy prices will be bought again because this is garbage. You cannot say that we are expecting warmer than expected winter when we have the scientists over at NOAA, the National Oceanic whatever, saying that we're going to have El Nino once again. Certain regions will be warmer, granted, specifically around the Bible Belt. We're going to have a drier season in the southwest, but we're going to have a colder season in the north. And it all depends on the high pressure blocking the polar jet stream. It could be a little lower, it could be a little higher. And if it is lower, then a huge chunk of the United States will experience a colder winter. So when they say don't panic, we're going to have a warmer winter, it is time to panic. Here's the headline from the Washington Post. NOAA calls for stormy winter across the northern U.S., but mild, dry weather elsewhere. And here's the little subtitle. What does that say? It says, in many areas, the unpredictable polar vortex will determine the character and severity of the winter. So they're already calling something they cannot predict. Why are they doing this? once again to manage your inflation expectations. Rest assured, folks, don't panic about natural gas prices surging out of whack, heating oil prices, crude oil prices. This is the power of propaganda, and therefore I say the dip in energy will be bought once again. Now, don't get me wrong, the energy trade remains overcrowded for now. You talk to the guy down the street, the homeless guy down the street, and they tell you buy oil because oil prices are going to be 100. When everybody's expecting it to go to 100, perhaps the trade is overcrowded and we need to get some air out of the bubble. But I assure you, the bubble will be reinflated once again with dip buyers. Moving on to softs, what's going on here? We have gains for OJ, big one, about 5%. I'm still in OJ, playing the rebound. We also have gains for cocoa futures, surging higher by a little over 2%. We have lumber and sugar pretty much on the flat line, while we have losses, a pullback for cotton futures and coffee. What about metals? Gold pretty much in the flat line, not doing anything at all, along with platinum. Meanwhile, we have losses for silver, copper, and palladium. And we have bad news here for copper because the demand is out of whack. Meanwhile, one of the largest miners and providers of copper in the world, Freeport-McMoRan, a stock that I own in my portfolio, they're saying they're tapped out here. The demand is out of whack and there is no supply. We cannot keep with the demand surging higher and higher and higher. And therefore, we're going to get to a point, as legendary investor Peter Lynch said, buy the bullet stocks. When there is a war, stick to the bullets. What does that mean? Freeport-McMoRan is good, but they're not going to be able to keep with this pace of inflation. And at some point, you have to resort all the way down to the source, the bullet. And the bullet is, in this case, the commodities, futures. You're going to have to buy contracts for copper instead of buying the stock, FCX. This is the later stages of inflation. This is the stagflation strategy. For example, when it comes to oats prices are surging higher and higher and higher and higher. But one of the stocks that I own in my portfolio, STKL, SunOpta, one of the largest producers of oat milk in the country, the stock is suffering because, yes, in theory, they should benefit from oats prices surging higher because they can pass that extra cost to the end customer. The problem is they also have to pay the extra cost when they buy oats, the commodity, and therefore you have to stick to commodities and future contracts. It is the last resort in this stagflationary environment in the market. Inflation is hitting margins across the board. The strategy in stagflation investing is you buy the contracts until the whole thing blows up. But what about meats futures? They're also down. Lean hogs are down big, over 3.5% today, and we have losses for live and feeder cattle futures. Grains pulling back, lots of profit taking here. The inflation trade is cooling down, at least for now. Everything is down. Soybean meal, soybean oil, corn, wheat, oats, canola, rough rice. Everything is down. And I have a hint here, I have a clue that perhaps the dollar will start to trade higher if the market starts to sell off. And this will add more pain and more profit taking for these commodities, at least for now. On the bright side, this will create a dip for us to get engaged in investing in commodities once again. Moving on to the big casino, the options market. What's going on here? Leading the pack, the hottest table in the casino today is Tesla, the souffle, with about 1.5 million contracts exchanging hands today. About 50% of those were calls. We have some funny business here that took place in Tesla today. I will cover that in the charts analysis. I will show you the options grid and what happened today. At number 2, we have Apple with about 1 million contracts. About 66% of those were calls. And at number 3, Ford, surging higher, with a little over 600,000 contracts, about 79% of those were calls. What about the unusual activities that took place in the options market today? We have plenty of them. Starting with the ticker DIDI. This is for DD. Of course, Chinese names appears to be bottoming for now, and options traders continue to buy call options contracts. They're not necessarily buying the stock. This is the risk reduction strategy. If you want to go along Chinese stocks, you're confident you have a bottom, you buy call options, and then you have the option to exercise your options and buy shares. In this case, they bought the $12 calls for DD with the expiration date of November 19th, with expectations that the name could pop higher by more than 22% by then, and they paid about 44 cents a piece, all in all spending about $1 million. And here it is, the ticker PINS, Pinterest, was down today, but the likelihood is we will see more short covering in Friday's session. But pay attention now, what if Pinterest also goes down in empathy with the crash in Snapchat? Regardless, they already bought these. If they lose, they lose. Who cares? but they bought calls, the 66 calls for the expiration date October 29th, with expectations that Pinterest could surge higher by more than 7.5%, by then. They paid about 90 cents apiece to enter this trade, all in all, spending about $1.3 million. And then we have the ticker FCX, Freeport McMoran. We have a spread here, a call spread. They bought the 43 calls and they sold the 48 calls, all for the expiration date of December 17th, with expectations that Freeport McMoran will pop higher by more than 12% by then, but not more than 25%. They paid about $1 a piece for the 43 calls that they bought, and they received about 40 cents in premium for the 48 calls that they sold. All in all, they spent about 60 cents a piece for this trade, spending a total of about $700,000. What about the trade for the ticker eBay? EBAY for eBay. You're smart enough to get it, right? They bought calls here, the 82 calls for the expiration date, October 29th, with expectations that the name could pop higher by more than 8% by then, and they paid about 50 cents a piece to enter this trade. All in all, spending about $550,000. What about the trade for the ticker EWZ? This is the Brazilian ETF. It was down big today. We covered the news last night of the upcoming indictment of President Bolsonaro, but somebody's buying the dip here, the 32 calls for the expiration date November 5th, with expectations that the EWZ will rebound by more than 6.5% by then. They paid about 35 cents a piece to enter this trade. All in all, spending about $350,000. And what about the trade for the ticker QQQ for the triple Qs, the NASDAQ? They're buying puts here, the 350 puts for the expiration date December 3rd, with the expectations that the Qs could go down by more than 7% by then. They paid about $2.65 a piece to enter this trade. All in all, spending about $2.3 million. What about the trade for the ticker PayPal? PYPL for PayPal. You know, Kramer keeps saying, buy PayPal, 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 even though PayPal went down because they're acquiring Pinterest and they're paying top dollar here. Regardless, somebody's calling a bottom here for a rebound at least. They're buying the 260 calls for the expiration date, October 29th, with the expectations that PayPal could surge higher by more than 7% by then. They paid about $1.75 a piece to enter this trade. All in all, spending about $1.5 million. At the bottom of the table, we have the ticker TAN. This is the solar ETF. They're buying puts here, the 82 puts for the expiration date, November 19th, with expectations that the name would go down over 9% by then. They paid about $1.45 a piece to enter this trade. All in all, spending about $1 million. Continuing with interesting trades, what about the trade for the ticker UVXY? This is for the VIX, and they're buying calls, expecting the volatility index to pop higher. They bought the 18 bucks calls for the expiration date, November 12th, with the expectations that the UVXY could pop higher by more than 10% by then. They paid about $1.40 a piece to enter this trade. All in all, spending about $950,000. Lastly, what about the trade for the ticker SNAP? Snapchat. Somebody got it right. And somebody is going to have Christmas early this year because they decided to buy the 67 puts for the expiration date tomorrow, October 22nd, with expectations that the name will drop down by more than 11% by then. Well, guess what? The name is down over 20%, so they're going to score big here, and they paid about 80 cents a piece to enter this trade, all in all spending about $400,000. Moving on to the heat map analysis, what's going on here? It is evident that the inflation trade is not performing today. Financials down, energy down, materials down, and the reason is we have earnings from Dow, and Dow was down, and you guessed it, the margins are getting squeezed due to the rise in inflation. What's working today is the deflationary side, the tech and momentum for now. The problem is, of course, yields are popping higher, surging out of whack. It is just a matter of time before the short covering and the dip buying in expectations of earnings will be met by disappointment. A truck gonna hit your face right away. You're already seeing it with Snapchat, and there is more to come. And therefore, where are you gonna hide in this market? For now, at least for me, it is healthcare. But how long will this one last too? Specifically for insurers, because we have the Great Resignation. Millions of workers already resigned or retired. For those retirees, they're gonna go into a government program. They're not gonna pay insurance insurance anymore. For every worker that gets fired or resigns, the forward guidance for insurance companies will be bad because they're losing more paying customers. So I would stick to the big pharma names, perhaps some diagnostics, maybe the consumer staples now that we have some earnings from Procter & Gamble, Unilever, and Nestle. All of these companies are now saying we're going to flex our pricing power. So perhaps these names are good to hide in for now. Moving on to charts, let's start with the SPY 30 minutes chart. What's going on here? The melt up goes on and on and on. And we're now getting closer and closer and closer to all-time highs. The chart is just few cents shy of the all-time highs. For now, the big guys are not doing anything. They're not buying, they're not selling. We're seeing some dip buying from retail. We're seeing some short covering here and there. But all in all, the algo's been doing the hard work of pushing the market higher and higher and higher, riding the escalator higher. The problem is, will reaching all-time highs elicit a reaction from the human being to start selling and booking profits? Because so far, I'm not impressed with these earnings. And the stock market should not be trading at all-time highs when we have inflation shrinking corporate margins. Are we going to see the elevator down scenario? This will only happen if the human being reacts. But if the human being stays on the sidelines, the algos will continue to do the work, pushing the market higher and higher and higher, slowly but surely. The resistance for now at around 454, the support remains 447. And boy, we have a lot of gaps to cover downstairs. Moving on to the daily chart of the continuous contract on the SPY. The volume continues in negative divergence, meaning the algos are doing the job right now, and the chart is almost at all-time highs at around 4,549.5. Again, we called the rebound the so-called relief rally, but did we expect that the chart will blast all the way to all-time highs? Not me. I thought we will have a blast higher, but it will stop at least at the neckline of the head and shoulder. But now we're trading almost at all-time highs. This is the magic of algos when they do the job on blindfolds. No regard, no calculation whatsoever of fundamentals, news, the technicals, not at all. The algos, when you program them on autopilot, they're going to do the buying regardless. But the human being will react sooner or later, and the volume will surge higher. Once the volume comes back into the market, we will see a reversal. The escalator higher, the elevator down. For now, the momentum indicators remain intact, although we are starting to see some curling down here in the RSI and MACD indicator. Look at the green columns in the MACD indicator. If they start to get shorter and shorter and shorter, then we are in the process of the reversal. You also have to combine that with the volume. You need to see the volume sparking higher, reversing the negative divergence that is still here for now. Moving on to the Qs, 30 minutes chart. What's going on here? The melt up also continues here, although we have a problem because after hours, Snapchat is shot. Likewise, Facebook is down, Google is down, Twitter is down. If they continue to open like this in the morning, then the Qs will also open down. Now you have to keep the psychology in mind. The chart went down. It was a massive correction in September. But what happened after that? The chart rebounded fast and quick, pretty much to all-time highs. What does that do to the psychology of market participants, specifically in the retail side? Those who did not join the pop higher, the rebound higher, they're now experiencing FOMO. They're sitting in the sidelines with a lot of FOMO. If there is a dip in the morning, you bet they will run right away to buy the dip. This could be a bull trap, because the chart's not going to melt up higher when we have trouble with earnings. I continue to build on a put options position on the Qs. Moving on to the daily chart for the continuous contract in the Nasdaq. What's going on here? Unlike the SPY, the chart did not go all the way to all-time highs. The volume is surging higher, indicating we have more trouble here in the Nasdaq versus the SPY. The MACD indicator, the columns are getting a little shorter here, the green columns. Likewise, in the RSI, it appears to be a curling down in the momentum. All of these are signs that the rebound is running out of gas. Support number 1, if the Qs go down in the morning, will be 15,192. Support number 2 will be 15,000. Will market participants see the dip as an opportunity to buy, specifically for names like Facebook? That would be the only reason for the Qs to surge higher to all-time highs. If we have more dip buyers excited by the dip, in names like Facebook, Google, and Twitter. Here is a chart for the IWM, the Russell 2000 30 minutes chart, and the chart popped higher in the morning. The bull flag played out all the way to the resistance of around 229. But I told you, watch out for the rotational nature of the market. The IWM popped higher in the morning. The Qs was actually down in the morning. The moment the Qs reverted and started to trade higher, the IWM also reversed and started to trade to the downside. Isn't this interesting? The rotational nature of the market right now. The psychology is you hide for a little while in the IWM and the inflationary side of the market, and then when that becomes overbought and overcrowded, you switch to the Qs and the deflationary side of the market. Back and forth. Back and forth. Here's a chart for the dollar index, the Dixie. It is trading below the support, but watch out for tricky Dixie. Everybody's assuming that it is dead. We have a top. It's going to trade down. What do you know? Tricky Dixie does the opposite and climbs over the support once again. Specifically, if we have a sell-off and a rush to raise cash, then the dollar will pop higher. This will not be good for commodities and gold. Speaking of, here's the chart of gold, still holding above the Fibonacci support, but how long can it hold when we have yields popping higher and perhaps the dollar is about to resume the pop higher? The answer is not so long. And here is the chart for the 10-year yield. Again, we have a channel, a defined channel, with higher highs and higher lows. We are reaching the top of the channel for now. Will this produce a pullback? We'll see, but for now, yields are trading higher. They're eyeing 1.7%. They could reach this number, the destination, the target, and then it pulls down. But the assumption for now, yields will continue to move higher until and unless we have a reversal signal from a candlestick pattern perspective. Until we have that, then the assumption is yields will continue to surge higher. Perhaps looking at the weekly chart for the TLT can shed some light about an upcoming top in yields. For now, it doesn't say so. For now, the candlestick pattern remains bearish. It remains negative. Likewise, the momentum indicators, the MACD and the RSI, are also curling down with negative divergence in both. So for now, the assumption, yields higher, bond prices lower. And here is the 4 hours chart for the VIX. And we're waiting and we're waiting and we're waiting for the pop. In the VIX pretty much closed all the gaps. 3 of them already closed now. We're waiting and waiting and waiting for the pop. It could happen tomorrow. How big can it be? This remains the challenge. Market bears want the VIX to pop all the way above 20, preferably closing the week above 20. This is a long shot. We're trading now at around 15. On the other hand, market bulls want to crush the VIX Fridays. Fridays mean crushing the VIX. The problem is it is already down. It is already at suppressed levels. So the risk is to the upside in the VIX, that we're going to see a pop higher. And here is the chart of Apple, daily chart. It is struggling to break above the resistance of 150. It is building the energy for now, going back and forth in consolidation. Will it build the energy enough to pop above 150 ahead of earnings? Let's say it does. The chart of Apple breaks above 150, perhaps trades all the way to all-time highs. This will be an invitation for market bears to buy puts, and the reason is we have a lot of yayo spreading around here, and therefore consumers are buying gadgets from Apple. It's a different picture over at China. The consumer is weakening by the day, so I don't expect the spending from China to come out impressive. So I hope that the chart will blast all the way to all-time highs, because this will be an excellent put options trade. And by the way, did you notice that the IMOB doesn't have a jab mandate? Even though if you go on Apple's platforms and you protest the jab mandates, they'll ban you, right? They'll kick you out. The iMob, how dare you speak up in our store? We crack up your kneecaps. But somehow they don't have the same mandates. Why? Because they're scared and they're afraid of losing talent. Yet they continue to support other companies imposing draconian mandates on their employees. Moving on to the souffle, Tesla, what's going on here? Again, this is not a regular chart. You don't see a pop like this in the morning. This is not normal behavior. This is manipulation of the chart. Somebody was holding the bag, the 900 calls, and they decided to do a block buy in the morning to pop the chart higher all the way to 900 to close the trade and perhaps hold a smaller bag. When you look at the options grid, for example, the 900 calls for the expiration of this Friday had massive open interest, but this open interest went down significantly today. Meanwhile, the volume surged higher. What does that mean? Somebody closed a lot of these 900 calls contracts today. They bought them ahead of time, anticipating Tesla would pop after earnings. They paid top dollar for these premiums. What does the stock do? After earnings, the stock trades down. and therefore they hold the bag in these premiums, in these contracts, the call options for the 900. Then they have to resort to manipulation to rescue their asses. This is somebody big, by the way. This is a major whale with billions of dollars. They can manipulate the market this fast and this quick and this easy. When we look at puts, we don't have a high open interest here. Nobody was interested in buying puts for some reason on Tesla. They bought puts for longer expiration dates. They were not expecting Tesla to pop higher, to drop in the short term. Yet they do expect the souffle to trade down in the next few weeks. So the majority of puts are taking place for the expiration date in November and December, even in January. The majority of calls are very short-term dated. They expire weekly, and it is always the same guy, the same whale, buying these short-term dated calls for weekly expirations. And when the trade don't work out, they resort to block buying of the stock to push the stock higher, and they dump these calls, and then few days later they dump the shares. Lather, rinse, repeat. And where is the SEC, by the way? This is what the SEC doing right now. Now let's move on to a daily chart for the souffle. It is already trading at almost all-time highs, let's say around 900. The chart already traded around 900 intraday. Look at where the RSI is trading. It is at a sell zone. Not a sell signal, but it is a sell zone. We have a trend line. There is a massive divergence right now. In all likelihood, the chart will flush down all the way to the trend line, which will be around 17% correction top to bottom. And therefore, let's revisit the options trade that I had pre-earnings. The trade was a calendar put for the 800. I bought the 800 puts for the expiration date, October 29th. And I sold the 800 puts for the October 22nd expiration, meaning this upcoming Friday, tomorrow. All in all, paying about $4. The assumption is that the 800 puts for the expiration date tomorrow will expire worthless, unless Tesla crashes by $100. And where does that leave the trade for now? Well, the 800 put options for the expiration date of 29th of October, they are now trading at around $4.65. So the trade remains profitable. The trade is acting exactly as we expected. What do you do now? You have the option. You can double down and buy more, or you can wait for the stock to trade a little higher, and then you add to your position once again at a cheaper price, therefore averaging down. This is of course with the assumption that the $800 calls that you sold for the expiration date tomorrow, these will expire worthless, and then you can continue to ride on the 800 puts with the expiration date of next Friday. Now you can also roll out by buying the 800 puts for the expiration date in November. And this is probably what I'm going to do here. Dumping these puts, the 800 puts, for the expiration date October 29th at a profit, and then rolling out to the 800 puts for the expiration date in November. I have not decided yet, but I will make a final decision tomorrow. Moving on to BTC tulips, what's going on here? We have a pullback for now. The momentum indicators are topping, they're curling down. Perhaps we're losing some energy here. I called the top yesterday. I bought some put options in Coinbase. These are working for now, and the reason behind the call was the drop in volume in Coinbase, indicating that we're topping out in the bullish energy and momentum. We also have another sign. Of course, Reverend Elon tweeted this last night, and this was the confirmation. And perhaps Reverend Elon will suffer from the Trump syndrome. Every time he brags on Twitter, it is a sign for a top. We'll see how this works. But it appears so. It's a pattern for now. Every time Elon brags, we have a top. And for now, we have a top in BTC. We'll see how long this top will last. And by the way, there was some funny business in Binance where Bitcoin dropped over 87% today. It was a mistake, of course, but there was a little panic here when certain people looked at the screen and they were down 87%. They're blaming this on a fat finger trade, but who knows what's going on here. The tulip market remains a jungle, predators and preys all over the place, so you have to proceed with caution. I should actually say that the tulip market is a swamp, because the stock market is a jungle. So this makes the tulip market even more dangerous. Lastly, moving on to AMC. Apes, what's going on here? We had the head and shoulder formation, and therefore AMC flushed down, yet capturing the support of 39 for now. How long will this last? Who knows? But the sentiment is shifting from the Wall Street Bets crowd, the Reddit crowd. They're all busy right now buying the SPAC of Trump. So will this be a distraction on the expense of AMC? We'll see. If 39 doesn't hold, then we have 36.5. If that doesn't hold, then say goodbye. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the manufacturing and services PMIs. This will be an important indicator regarding inflation, but we already know what's going on. From corporate earnings, inflation is surging higher, and it is squeezing margins across the board. We also have the top dog, Jerome Powell. He is also speaking to the Settlement Bank, and let's see if he says anything about his crimes of insider trading, or perhaps he will shed more light about substantial further progress when it comes to inflation and employment. But knowing Powell, he will probably try to distract by talking about climate change and racial inequity, yada yada yada. Anyhow, folks, this is all I got for you for now. Thank you for watching, thank you for listening, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.